If your parents give you $1 million, your net worth will increase by $1 million, and your parents' net worth will decrease by $1 million. What about the family net worth? Does it increase, decrease, or remain the same? The answer is, it will remain the same, because it is a transfer of funds from one family member to another. The family as a whole did not receive additional funds from people outside the family, neither did it give out any funds to people outside the family. In business, you will realize that multiple companies can be related to each other. This means if a company engages in a transaction with a related company, the transaction will be regarded as an internal transaction within the group of related company, because it is not a transaction with an external party outside the group of related companies. The next question now is, how do we know if one company is related to another company? We need to look at whether one company has control over the other company. Companies often have investment in other companies. The company that invests in another company is called the investor, and the company being invested on is the investee. An investor controls an investee if three criteria are met: power over the investee, exposure or rights to variable returns from its involvement with the investee, and the ability to use its power over the investee to affect the amount of the investor's returns. Please note that an investor controls an investee only if all three criteria are met. To determine if an investor has power over the investee, we need to assess if the investor has existing rights that give it the current ability to direct the activities that significantly affect the investee's returns. Power arises from rights. Sometimes, assessing power is straightforward, such as when power over an investee is obtained directly and solely from the voting rights granted by equity instruments, such as shares, and can be assessed by considering the voting rights from these shareholdings. The rule of thumb is, if the investor owns over 50% of the investee's shares, he has power over the investee. Of course, this is just a rule of thumb. Sometimes the assessment is more complex and require more than one factor to be considered. For example, when power results from one or more contractual agreements. An investor is exposed or has rights to variable returns from its involvement with the investee when the investor's returns from its involvement have the potential to vary as a result of the investee's performance. These usually arise from dividends declared by the investee. If the investee performs well, it may declare more dividends, which is the investor's returns. On the other hand, if the investee does not perform well, it may not declare dividends, and the investor will not receive any returns due to the investee's poor performance. Most important of all, there must be a link between power over the investee and exposure or rights to variable returns from its involvement with the investee. The investor must have the ability to use its power to affect the returns from its involvement with the investee. This usually comes in the form of decision-making rights, where the investor can vote for or against matters that may affect the investee's performance. Let's see how this works. Look at the following diagram. Company A owns all the shares in Company B and 80% of the shares in Company C. Company C owns 70% of the shares in Company D. For the purpose of simplicity, we will assume that if the investor holds over 50% of shares in the investee, he has power over the investee and can use its power to control the investee. If an investor controls an investee, the investor is known as the holding company and the investee is known as the subsidiary company. Since Company A owns over 50% of shares in Company B and Company C, it controls and is the holding company of Company B and C. Company B and C is a subsidiary company of Company A. Company C controls and is the holding company of Company D because it owns over 50% of the shares in Company D. So Company D is a subsidiary of Company C. Is Company A the holding company of Company D? We can calculate the indirect shareholding it owns in Company D by multiplying the shareholding A owns in C by the shareholding C owns in D. 80% multiplied by 70%, which is 56%. Since it exceeded 50%, Company A controls Company D through indirect shareholdings in Company C. Company A is the holding company of Company D, and Company D is the subsidiary company of Company A. Company B and C are known as affiliate companies. These are companies which are owned by the same holding company. If the investor controls the investee, the investor or the holding company is required to prepare consolidated financial statements. Consolidated financial statements are the financial statements of a group where the assets, liabilities, equity, income, expenses, and cash flow of the holding company and all company it controls are presented as those of a single economic entity. In the previous case, we realized Company A owns Company B, C, and D. So it means Company A will prepare a group financial statement that combines all assets, liabilities, equity, income, expenses, and cash flows of Company A, B, C, and D. If a holding company owns a subsidiary company, strictly speaking, it owns the asset and assumes the liabilities of its subsidiaries. That's the rationale behind consolidated financial statements. When consolidating the financial statements of the holding company and its subsidiaries, we will eliminate the holding company's investment in each subsidiary and the holding company's portion of equity in each subsidiary. Eliminate in full intra-group assets and liabilities, equity, income, expenses, and cash flow relating to transactions between entities of the group. This is similar to the example provided at the start of this video, where I told you any transactions between companies of the same group is regarded as an internal transaction that should not be reflected in the financial statement. Finally, we will combine like items of assets, liabilities, equity, income, expenses, and cash flow of the holding company with those of its subsidiary. We will go through each of these accounting procedures in future videos. Let me introduce you to the consolidation worksheet. It looks something like this and it mainly helps with the consolidation process. As you can see, we have one column for the holding company figures and one column for the subsidiary figures. I am assuming here there is only one subsidiary company. There would be more columns if the holding company owns more subsidiary companies. Towards the extreme right, you will see a group total column. By default, the group total column is derived by adding the figures in each individual company. Towards the left of the group total is a consolidation journal entry column. Remember in the previous slide I told you the accounting procedure for consolidation include eliminating some of the account balances? That's the purpose of the consolidation journal entry column. Since we will be adding each company's balance line by line by default, we will inevitably add some balances that should not appear in the group financial statement. For example, let's say the two companies sell to each other and have trade receivables and payable balance in their financial statements. We don't want to include them in the group total since it represents the balances among companies within the group. To eliminate them, the consolidation journal entry is debit trade payables and credit trade receivables to reduce the balances. Not to worry, more details on consolidation journal entries will be covered later on. This is just to give you a rough idea how consolidation works. One more important thing I need you to note is, the holding company will not maintain a group accounting system. This means at the end of each year, the holding company will prepare its own financial statement, and the subsidiary company will also prepare its own financial statement. Then, the holding company will do the consolidation process from the very beginning. Any consolidation journal entries recorded in the previous year will need to be re-recorded again for the current year. This will also be covered in greater details in future videos.